Okay, oligopoly, a complicated word. Perhaps you've never come across it before. Let me explain a little bit about what we're doing today. So first, a little bit about the past. Last class, we talked about the theory of monopoly. And to emphasize again, the approach we're taking in this class is a little bit different because we're doing a build-up approach. We're starting from barest essentials, and we keep adding on and complicating the market and the economy that we're trying to understand. So we started with pure exchange, Smith & Jones. We started with production with Smith & Jones and coming together and specializing in trading. We moved to the demand curve and talked about that in general. And then we introduced monopoly, the cost functions of an individual firm. And we thought about how a single firm supplying a group of consumers or customers in a marketplace would likely behave in the sense of how would they determine what output to set, what price to set, what would be their objective, which we claim to be maximizing profitability, and how would they achieve that particular objective if they were the sole firm supplying a product to the marketplace. So we worked through those results. Today, what we're going to do is we're going to make a jump, first bullet point here, from monopoly to duopoly. Now, duopoly, the word, the prefix is duo, means two, and that's exactly what we're going to jump to. We're going to imagine not one firm in the marketplace, but we're going to imagine what if there are two firms in the marketplace competing against each other to supply, again, a group of consumers who are out there wishing to purchase the product at different prices. All right, but we're going to then look at the effects of just adding one more firm into the marketplace and see what happens to the prices of the good, the profits of the individual firms, the welfare levels of both the firms and the consumers in the marketplace. And we're going to analyze what are the effects of having a duopoly, and we're going to compare them to what happens in the case of a monopoly. You'll see that. Now, we're not going to do this too formally, but the next step would be to move from duopoly to oligopoly. And oligopoly means that you've got a small number of firms, each of which are big enough to have some influence over the price and the behavior of the marketplace, but where there's more competition than there would be with just two firms operating against each other. And probably oligopoly is a good description of a lot of markets in the world, because markets, they don't have an infinite number of firms, perfect competition, which is what we're going to jump to next. But they do have a kind of a large number, and some of them are pretty sizable and influential in their individual markets. And so probably oligopoly is perhaps the best representation of many markets out there. And we're going to get a sense of what happens in oligopoly by understanding just that one step of moving from one to two firms. And then we can infer kind of what would happen if we added another firm and another firm and another firm until we had a small number of firms competing against each other. All right, so we'll talk a little bit about that later. And then the last thing we're going to do today is we're going to introduce the notion of game theory and introduce what is a very, very important concept in the social sciences, in econ, in poli-sci, in just about everything, is to understand the essence of the prisoner's dilemma game. And we're going to talk about individual firm behavior in a market and think about how that can be characterized and kind of lead those individual firms into what's called a prisoner's dilemma. And we'll define that and talk a little bit about that later. Okay, so let's go forward. Here's what we're going to do. We're going to start with the diamond market example from Monopoly that we worked through last week in class on Wednesday. Okay, but I'm going to make just a little bit of an assumption adjustment relative to what we did last week so that it looks a little bit different and you can see how things will change when we change some of the assumptions. So first of all, the thing we're not changing is the demand function. The schedule here in the first two columns of this table are showing us the demand function for diamonds. And once again, remember, we had prices that are decreasing. These are measured in the thousands, 10,9,876 discretely, and we've got quantities increasing. So we've got a really simple demand function that's represented here, and we're going to use that again. The change I'm going to make, though, is relative to last week, is I'm going to imagine that instead of $1,000 marginal cost per diamond, we're going to imagine the marginal cost is fixed at $3,000. So just another value that we can plug in. It's going to generate a different equilibrium outcome. And then we're going to use this as our starting point for the analysis of a duopoly. I could have done $1,000 as well, and then we would have just duplicated the example from before. It doesn't really matter. But again, just to give you another look at another situation, we're going to do it this way. Now, as before, we imagine there are no fixed costs in production, so that gives us a very simple marginal cost equals average cost, which is horizontal at the level of marginal cost. The cost curves simplify to that particular nature. Now, the first thing we're going to do is talk about the monopoly outcome under this slightly different set of assumptions. And if we take a look at the table on the far right now, one thing I want to highlight is that what I've done is I've actually spaced out the individual points on the demand curve just a little bit and separated the 10 from the 9, so that in essence there would be a 9.5 in here under price, and there would be an 8.5 here. There are values that exist that are not represented in a table like this. When we do the marginal revenue, for example, and do this calculation of 6, remember, we're looking at the change in total revenue, that's $6 million going from 30 to 36, compared to or divided by, we're going to divide by the change in quantity, which is this 3 to 4,000, which is an increase in 1,000 units. Okay, and then what we would do before is we would take that 6 and we would place it like here, 30 to 36, and the marginal revenue is 6. But really, that $6 is in between the 30 and 36. So it's really corresponding to the value of marginal revenue when the price is $9.5 thousand rather than $10,000 or $9,000. Okay, and that means we could put the 6 there in between the 30 and 36, the 4 here in between the 36 and 40, and so forth. Now, the reason for doing that is that if we do it that way, you'll notice that the marginal revenue at the value of a price of $8,000 and a quantity of 5 turns out to be exactly equal to marginal cost. And that's what is our profit maximizing condition for the monopolist. Marginal revenue equals to marginal cost. And when we did the discrete version before, we were matching up this 4 and this 3. And that's not equal, of course. But it also, we can look at the far right and we can see where the maximum profit is going to be. It's going to be right here at $25 million, which is at a value of $8,000 per diamond. Okay, so by spreading it out just a little bit, we can equalize and show that indeed at that particular price point, we've got an equalization of marginal revenue and marginal cost, and we've got the maximization of profits for the individual firms. Now, I will point out that when we do this diagrammatically, when we draw a marginal revenue function, that straight line diagram right here, and we draw a demand curve function, what we're doing here is we're representing all of the different possible prices and quantities that could come about. And the same thing is true for marginal revenue at each individual quantity. All right, so when we do it this way, we don't end up with that complication that arises from a schedule of prices and quantities. It just works out a little bit easier. And that's actually one of the reasons why, if we could use calculus in this course, which we won't, but if we could, a lot of these problems just kind of work out to be mathematically a little bit more easier to work out. The explanations when we do things in discrete terms are always a little bit more complicated than they need to be because of sort of our lack of mathematics, if you will. All right, but enough on that. So here's the same problem that we were just looking at with the table, but we're looking at it diagrammatically instead. And so notice, first bullet point, marginal cost as a function of quantity is equal to $3,000. And that's listed right here. This is the marginal cost function. It's a horizontal line, so regardless of what the quantity is, marginal cost is always going to be $3,000 per unit. All right, now marginal revenue. I'm giving you the equation for marginal revenue, and like I said, it's always going to be intersecting the demand curve up here, where the demand curve crosses the vertical axis, and it's always going to be crossing the horizontal axis at the midpoint of the demand curve. All right, and then it's going to become negative down here as we increase quantity beyond the midpoint, and we get into the inelastic range of the demand curve. Okay, but that marginal revenue curve has a functional form. It's going to be equal to 13 minus 2q. You can take my word for that. And sometimes I will actually be giving you say set marginal revenue equal to marginal cost and solve. And you can actually set these two equal to each other and solve for the quantity. And if you did, you're going to come up with this quantity of 5. 5,000 units is going to be the quantity that's going to maximize profit, again, in this monopoly situation. Now, if you take the 5 and ask what the price is going to be, don't go up to here where the 3 is. Instead, carry it all the way up to the demand curve, that quantity, and then over to determine what the price would have to be in order to sell 5,000 units, 5,000 diamonds in the marketplace. Okay, and that price is at 8. It's measured in thousands. So therefore, you mark the price as $8,000. Okay. Now, we can calculate, as we have done in the table before, we can calculate the total cost and the total revenue. Total revenue is going to be equal to the price times the quantity. So 8 times 5 works out to be $40 million. Total cost is going to be equal to the quantity times the marginal cost. This is marginal cost times quantity at the equilibrium. And the marginal cost is $3,000. The quantity is 5,000. 5 times 3 is 15. Because they're both in thousands, we're going to end up with $15 million as the total cost. Okay, and then that gives us total profit, which is equal to total revenue minus total cost. Just take the difference between those two, and that's where we get the $25 million. All right, so I've done nothing new so far. Everything I've done is just a repeat with a different marginal cost of everything we did last week in class. So let's do something new. Monopoly with 2 owners. Let's imagine that this is a firm, a monopoly firm that was owned by, owned by a family, and suppose that a brother and a sister take over the family business, okay? So we're going to split up the firm, kind of, having 2 separate owners of this individual firm. But we're going to imagine that these 2 individuals, brothers and sisters, are getting along with each other, and they care first and foremost about maximizing their profitability. They want to make as much money as possible. So at first, we're going to imagine, bullet point 2, that they're going to operate as a cartel or create a collusive agreement where they act as if they're one firm. And we can imagine, just for the sake of this story, that the firm, this monopoly firm, has 2 different factories, let's say. And factory A is owned by the sister, and factory B is owned by the brother, and they're going to operate their factories, but they're going to make joint decisions about what's best for the company overall, and they're going to act like a monopoly in their behavior. All right? Now, I want to throw out a couple of terms down here on the bottom, and I want to highlight the fact that a cartel, the definition of that is an arrangement where 2 individual firms or a collection of firms get together and they coordinate their activities or actions. They try to do what's best jointly rather than trying to do what's best individually. And that means the formation of a cartel. Another word that we use in line with that is collusion. So collude means to act together, to act intentionally, to act as a group rather than acting individually again. Another term that is often used in this context is the term price fixing. And this is where individual firms who might be operating separately at first come together and they agree to adjust their prices in an agreement with each other. So they collude with each other in order to fix the price of their product at an agreeable or agreed upon level. All right, and that's another term that's also associated with this monopolizing behavior in a particular marketplace. And then the last term to emphasize is a merger. A merger means the purchase of a firm by another firm. And if that merger is taking place in a business where the 2 companies are producing exactly the same item, then that's an example where you're taking a more competitive market, and you're moving in the direction of monopoly because 2 firms are becoming one, and then we'd expect that one firm to operate in its own best interest overall rather than the individual company best interest after the merger takes place. So all of these terms are associated with what we might call monopolizing behavior, moving in the direction of a monopoly. All right, so those are some definitions of terms. Now, here we're starting with a monopoly, And we're imagining that the siblings are going to operate as a cartel. And here's what they're going to do. They're going to, in the last bullet point, split their output equally in their two separate factories. And if you go back to this table up here, what we're basically going to do is we're going to take the total quantities here at, for example, $10,000. The quantity is 3,000 units in total. Well, we come down here and we're just going to split up that 3 into 1.5 and 1.5 and split it up between firm A and firm B. All right, so we've got the sisters firm A and we've got the brothers firm B, and they're just splitting up their output equally, producing half of the total amount at that particular level. And then we're doing that all the way down. Okay, so we just split up the market equally between the two individual firms. And then we could go through and say, okay, well, how much would the firms make in each of these individual situations? And the profits are created and highlighted here for both firm A and firm B. They're identical because they're equal, they have equal outputs. And we can see that the profit maximum is going to be where they split up that 25 million from before here. They take that 25 million in profit and they just split it equally between the two, 12.5 and 12.5. Okay, so this is still no change from what we had done last week. It's just that we've got two firms operating in this monopoly situation. So let's mix it up a little. Next step. Let's suppose that the brother and sister have a disagreement. All right, and the brother, being extremely angry with the sister for whatever reason, you know how sibling rivalries can go, decides that he's going to take it upon himself to do whatever he wants in his firm, and he's not going to collude or cooperate or talk with his sister about what should be produced. All right, and here's what we're going to imagine the brother does in firm B. Decides to maximize his own profit, second bullet point here, but he's going to start by assuming that his sister A remains fixed at the original quantity. So we're going to make a very simplifying assumption here because the dynamics of these kind of decisions could be really complicated. But we're just going to start off by saying, let's suppose the sister decides to just continue following the collusive agreement and producing 2.5 thousand diamonds each period. But firm B, the brother, says, hey, what if I mix it up? What if I change the quantity that I produce in my factory and adjust the quantity accordingly so as to maximize my profit over here, firm B profit? What would be the best for me to do? And here's where something really interesting occurs. So let's start out with this middle point right here, where they're both producing exactly the same amount. And firm B might say, well, let's lower my output by just 1,000 diamonds. Is that going to help me in any particular way? Okay, and if you do that, you're dropping 1,000 diamonds out of the total production of the two firms together. And so the sum, 2.5 plus 1.5, is going to be equal to 4, right? If you go back to this figure up here, 4 is going to match with the price of 9, and it's going to generate a total revenue of 36 and so forth. But we can come back here and calculate the individual quantities, the profits, in the following way. Now, profit, let me just point out a simplifying technique, is going to be equal to the price minus the average cost times the quantity. All right, or in this case, it's going to be marginal cost because they're equal to each other. Okay, in this particular situation. All right, so we can take the price of the product, say up here, $9, and we can subtract off the cost, which is $3. So it's going to be 9 minus 3 times the quantity. And if we want to find the quantity here, it's going to be 1.5 for firm B. And it's going to be that 9 minus 3, or 6 times 1.5, which is going to give me the profit of individual firm B over here at $9 million. Okay, and if we did that same thing for the sister, profit of A, at the price of 9, so it's going to be 9 minus the cost, which she also has a cost of $3,000 per diamond, times her quantity, which is going to be the 2.5, and that's going to give us the value right here, which is the $15 million. All right, so first step, if the brother decides to cut back production a little bit by 1,000 units, we see that he's going to lose money. All right, so that's not in his interest to do that, and we wouldn't expect him to move in that particular direction. Okay, but let's work in the opposite direction. Let's suppose that the brother decides to increase output. So again, starting point, colluding right here. But now let's imagine that the brother decides to increase output from 2.5 to 3.5. Now, again, because 1,000 units of extra diamonds are being produced, in order to sell them, the price of the good, according to the demand function, has to come down to 7. All right, now, when we do the profit calculation for B, we're going to be equal to the price, which is now 7, minus the cost, which is 3, times the quantity, which is now 3.5. And that is going to be equal to the 14 over here, 14 million. And that's where that number is coming from. Now, if we do the same profit calculation for the sister's firm, A, she's going to have a price of 7 minus a cost of 3, same thing, but she's still producing 2.5 thousand diamonds. Okay, and that's going to generate the value here of $10 million. So 7 minus 3 is 4. 4 times 2.5 is 10. 10 million is going to be her total profit. So that's where those numbers are coming from. And we could continue to do this, as has been done in the schedule, for all the different quantities, or at least a collection of quantities that firm B might produce instead. And we come out with firm B's profit schedule over here and firm A's profit schedule over here, which we don't care about because firm B is the actor here, making the decisions. And we can see that the profit maximizing output level has changed. Let's go down to the effects here. Same figure on the right, as I was just presenting, but a summary of the results. The first result is that B has an incentive to increase his output from 2.5 thousand diamonds to 3.5 thousand diamonds. And of course, the reason for that is because it's going to increase his profitability by doing so. All right, now, when he increases output in the marketplace, of course, that's going to force a decline in the price because the demand curve is downward sloping. So you can't just increase your output and sell as much as you did at the price before because there's not going to be sufficient demand for your product. So the price has to fall to $7,000 in this example, down from $8,000. All right, third step, output increases in total by 1,000 units. So there's more supply to the marketplace, and that's contributes to why the price has been able to come down. Now, firm B's profit is up, and this is his incentive, is to try to adjust his output so as to increase his profit above the monopoly level. And he's been able to do that. He's raised his profit from $12.5 million to $14 million. And how did he achieve that? In part by hurting his sister. All right, the sister's profits fall from 12.5 to 10 million. And so that's going to be the effect of allowing one individual in this cartel to break the agreement, if you will, or to cheat on the agreement that they had. So maybe the brother and sister promised that they would act in a unified way and try to maximize the joint profit of the firm, but the brother is now cheating on that agreement, going against his word, and is breaking it by increasing output. Now, maybe, prices are changing in the marketplace, and maybe the sister is going to suspect that her brother is not living up to their agreement. And maybe she can go out and measure and see, oh, the brother has now supplied an extra 1,000 diamonds to the marketplace. That's why the price is falling. Or maybe she might think, well, maybe the demand for diamonds is changing. Maybe there's some changes in other things that are causing the demand curve to shift. Maybe that's why the price is falling down to $7,000 instead of $8,000. Maybe it's not really because the brother has done something. My point here is that with imperfect information, the sister might not be exactly sure what the source of this price decline is. All right, but let's suppose she assumes the price decline is coming about because she thinks her brother is cheating on the agreement and is now digging up and supplying more diamonds to the marketplace. Okay, and let's say that that she wants to retaliate instead. Okay, now, this is the slide I added 10 minutes before the class began because it's something I wanted to talk about. Breaking up of a cartel. How does it happen and what are the possible consequences of it? I want to give you a real world example of exactly where something like this has happened. All right, and the best example I can think of is the OPEC cartel. OPEC stands for oil producing exporting countries, and it's a cartel that was formed back. Actually, it was probably formed in the 50s or 60s, but it really sort of exercised its power in the 1970s with an oil embargo to the world that had the effect of raising prices significantly. So in the 1970s, oil prices were through the roof. Crude oil, that is. So crude oil prices were really, really high, and it was because of the cartel behavior. And this was OPEC countries included, most of the countries are in the Middle East. So it includes Saudi Arabia and Iraq and Kuwait and Iran and Libya and Egypt, and all of the oil producing countries of the Middle East were a part of OPEC. But it also included some other oil producing countries, like Venezuela, for example, which is a big oil producer. And Nigeria was a part of the OPEC cartel. So there's lots of countries who were major producers of oil who entered into a collusive agreement to restrict oil production and output to the world market. The effect was to raise the price considerably and generate an enormous amount of profits to the countries involved. But in the 1980s, that cartel started to break apart. And individual countries decided to kind of go their own way and produce more than the cartel was necessary in the cartel in order to keep the prices propped upward and to generate the monopoly returns that was being generated during the 1970s. Okay, and as it started to break apart, it caused a lot of anger and consternation amongst the individual OPEC countries. Now, there were some countries like Kuwait that were notorious for increasing their production levels. They're not a huge producer of oil in comparison to Saudi Arabia and to Iraq and other countries at the time. But they would increase their output beyond their quotas and sort of cheat, if you will, on the cartel agreement. Now, what happened ultimately is that Saddam Hussein, the leader of Iraq at that time, was extremely irritated with the drop in oil prices and the lack of revenues that were now being generated. I mean, they went from this abundance of riches in the 1970s to almost having, very little extra profit because of low oil prices that prevailed in the 1980s. And Saddam Hussein was adamant about trying to get countries to live up to their agreements, to limit their supplies to the world. And Kuwait was a country that he was irritated especially with. Now, what you can do in that response is to do what we're going to show the sister is going to do in the cartel agreement or arrangement. She's going to break the agreement and is going to act in her own self-interest, and we're going to see what happens. But what Saddam Hussein did instead is he invaded Kuwait. And in 1990, he sent his tanks into Kuwait and took over the oil, took over the country, and set up the first Persian Gulf War that took place shortly thereafter. The result being US-led coalition troops went into Kuwait, liberated Kuwait, and sent Iraqi troops and tanks packing. But it's interesting also to note what Iraq did on their way out. Upon defeat, they set a large number of oil fields on fire. So where the oil is coming up out of the ground, they just set it on fire and they started burning. And this was another way of sort of reducing the supply of oil from Kuwait for an extended period of time, because it took a long time to get those fires out. It took a long time to get the oil fields back in production. But here's an example of kind of how the extremes to which individuals or countries will go in order to punish the behavior of a cheater in a cartel-like agreement. All right, so this is where it actually comes up in real life. Now, let's go back to our story of the monopoly and the diamonds. Let's suppose the sister notices that B is cheating, her brother is cheating, and decides, well, forget it. If he's going to increase his output to 3.5, let's say she's figured that out, he's increased his output, lowered the price to $7,000, cost her money. She's lost this money, $12.5 to $10 million, and he's come out way ahead. So what is she going to do in response? Well, let's say that she responds by saying, well, forget about the cartel agreement. I'm just going to do what's in my own best interest. And I'm going to adjust my output here in this column up and down until I can find, given that you're now producing 3.5 thousand diamonds, what's the best thing for me to do in that particular circumstance? Okay, so we're going to take bullet point number 2. Take B's quantity as fixed at 3,500 and let sister A maximize her profitability. All right, now once again, we're going to calculate profits over here in exactly the same way. Profit is equal to price minus marginal cost in this case. And I want to just emphasize, in more general circumstances, that marginal cost actually has to be average cost. The only reason I can plug in marginal cost here is because we've made it fixed and unchanging, and that means marginal cost is equal to average cost in this diamond story example. Okay, but we take price minus marginal cost, and we know the marginal cost is 3, and we're going to multiply it by the individual quantities here in order to get the profits that are listed over here. Now, if we do that exercise, we're going to find the following. A's maximum profit under this set of assumptions is going to be to increase her production from 2.5 thousand diamonds up to 3.5 thousand diamonds. All right, so she's going to move from this point, which is where they were under just B acting non-cooperatively, to A now acting non-cooperatively as well, and she's going to find that it's best to increase her output from 2.5 up to 3.5. Why? Well, look at her profits. Her profits are going to increase by doing that from $10 to $10.5 million. Now, she could decrease her output, and notice that's going to hurt her. Profits go down to 7.5. Or she could increase up too much to 4.5, and her profits would actually go down to 9. So the only action she's got that can actually increase her profitability is to increase output, again, from 2.5 to 3.5 thousand. Now, as a result of increasing output, though, the market price has got to fall again, because you can't sell an extra 1,000 diamonds on the marketplace at a price of $7,000. You're going to have to lower the price to $6,000 in order to get rid of all of these extra diamonds. Okay, so the price falls to 6, and that means you're going to have to do the calculations here on the basis of this price and the cost of $3,000 per diamond again. All right, now, so the market price falls 7 to 6, and we can see that firm A's profit goes up. So from 10 million to 10.5 million, not as much as the brothers did before, but notice what happens to the brothers' profit as a result of the sisters' action. The brother's profit is now falling from $14 million down to 10.5. He takes a significant hit from the sisters' competitive actions here, all right? And his profits are going to get pushed down, which will be satisfying to the sister who is responding and retaliating against the brother's initial action, of course. So she's going to be happy about the fact that her brother, who started this cheating, is actually going to suffer the consequences of reduced profits, no doubt. Okay, so that's where we end up with. Now, let's take a look at the comparisons of the outcomes here. And I want to kind of walk our way through what are the individual effects of competition now, because now sister A and brother B are competing against each other. They're not acting collusively. They're not talking to each other about what's best as a joint product or a joint production effort. They're each doing what's individually best from them. And by the way, we could do this exercise, go back a step here. We could go back and forth and say, okay, now sister chooses 3.5, what should the brother choose? And we could go back and forth, and that's the way in which we would grope our way towards an equilibrium. I think in this case, the outcome is actually going to be, we did this more technically, it's actually going to be right here where I'm displaying it. And so we would get both of the individuals increasing their output equally at this new competitive equilibrium. But let's take a look at the total effects, and let's just pause a little bit to reflect on what's happened here. So now, because the cartel has broken apart, we no longer have a monopoly. Instead, we've got a duopoly, two firms competing against each other. And we can compare the outcome of these two firms competing against each other with the case of the firm operating as a cartel or as a monopoly. Okay, so what happens with a duopoly? First bullet point. The price of diamonds, the product being supplied in the marketplace, is going to fall. Okay, and so that's the first thing. You should remember this from this point forward in your life. The effects of competition is going to be to lower prices. And we're seeing that happen right here in front of us. It's in the best interest of both of them when they compete against each other to lower the price of the product that they're selling on the market. And they do this because the second incentive is to increase diamond production. So both of them increase their diamond production by 1,000 units. Increased supply, decreased prices is what competition or the movement from monopoly to duopoly is generating here in this particular example. All right? Again, remember, lower prices, higher output from competition in this particular market. Remember too the reverse. So if we go back in the opposite direction and say we start with competition, but we monopolize the market instead, then what should happen? Well, if we move from a duopoly to a monopoly, if we start with competition and move to a cartel, then the effect is going to be to raise up the price in the marketplace and to lower the quantity that's produced to the market. So monopolization causes increased prices, decreased output. Competition causes the reverse, decreased prices and increased output. All right? Basically, this direction is caused by competition. This direction is caused by monopolizing. And those are the basic effects we're going to see. And this is going to carry through in our analysis as we go forward. The effect of competition is always to lower prices and increase output. The effect of monopolizing is the reverse. Okay, that's the first effect. Now, what are the effects on the individuals who are affected by this? Total profit has gone from the 12.5 plus 12.5, or $25 million, down in total to this, 10.5 plus 10.5. And that's going to be equal to the $21 million. So that's where I got the 25 million falls to $21 million. So the effect of competition moving to a duopoly is to actually reduce the total profitability of the individual firms. So we could say that competition is bad for business, right? So the individual businesses are doing worse now. They're not making as much money as they did before. So this should be the first thing that we recognize, that, hey, what is the interest of businesses actually? And, you know, in light of competition or not, what would they prefer? The answer we're seeing here is that they should prefer to have a monopoly rather than competition, because monopoly is going to give them total profit that's much, much higher than what they could achieve if they were competing against each other. So there's an incentive on the part of individual firms to move in the direction of monopoly, not in the direction of competition. Profitability falls. Okay, now if we look at the individuals involved here, the brother and sister operating their own independent firms, their profits are individually falling from 12.5 million to 10.5 million. So they're both losing out as a result of this competition with each other. The incumbent firms, and by that I mean the firms that are in the market originally when new competition arises. And in this case, both of them were in the market originally. They were colluding with each other. And both of them end up losing as a result of when the cartel breaks or they move towards increased competition. Now, this will also occur if we imagine that there's one firm operating in the marketplace and then there's a new entrant, another completely different establishment, not part of the family. Somebody else decides to maybe discover his diamond in a diamond mine and starts producing and supplying diamonds to the marketplace. The same effects that we're seeing here between the brother and sister is going to be the effect we're going to see on the incumbent firm in those particular circumstances. Profits of the incumbent is going to fall as a result of the new competitor coming into the marketplace for the first time. And so competition, regardless of how it occurs, whether the breakup of a cartel or the entry of new firms, is going to have exactly the same kind of effect, lowering prices, increasing output to the marketplace, and hurting the incumbent firm's profitability as a result. All right, so that's going to make entry of new firms unwelcomed, let's say, by incumbent firms in the marketplace. Firms don't want to see more firms coming in selling similar products because it's taking away some of their customers, it's taking away some of their market share, and the individual firms are going to lose out as a result of that. Okay, now we might stop right here and say, oh, well, this is bad for business. Maybe what we want is to just have monopolies then, because we'd like to do what's best for businesses. Businesses create jobs. We want to have people working, and we'd like businesses to make as much money as possible. So maybe we want to eliminate or discourage competition from taking place. Not true. Let's see what the other effects are. The other thing that we can measure here with our diagram now is we can measure the well-being of consumers in this marketplace, because we can measure consumer surplus. So in the original equilibrium, when they were acting as a cartel, the price was $8,000 per diamond, and they were selling 5,000 diamonds to the marketplace. Now we can calculate consumer surplus originally, and it's going to be given by this red triangle that I'm highlighting here, right? Okay, and that means consumer surplus with the cartel in place, that red triangle, is going to be given by 13 minus 8, that's this 13 and that 8, that's the height of the triangle, times 5, which is the 5,000 diamonds that is being created here. And I've skipped the thousands because I'm going to add it all in at the end. And we take it 1/2 of that because we're looking at the area of that triangle. And we're going to end up with a total consumer surplus with the cartel in place of $12.5 million of benefits that are accruing to the consumers who are buying this product in the marketplace. All right, and remember, like we said before, in a monopoly, all the people that buy the product are happy to buy the product because they're all willing to pay a little bit more than, in this case, the $8,000 that they have to pay for it. And that means they're getting surplus as a result. So the monopoly is actually providing benefits to consumers who are purchasing the product in the marketplace. It's a win-win situation. The monopolist wins, the consumers win, even in that monopoly situation. But now we're not just going to look at that as the only possible outcome. Now we can compare that outcome with what would happen if the two firms in this monopoly break up and compete against each other. Well, the effect is to lower the price, increase the output, and that means consumer surplus is now going to increase to this level here, the green triangle. And if we calculated the value of that, we're going to take now 13 up here minus 6, that's the 13 minus 6 in this equation, multiply it now by the 7,000 diamonds which are being produced, this distance right here, multiply by 1/2 because it's the area of a triangle, and we're going to come up with a value of $24.5 million in total consumer surplus. So now it's worth pointing out what happens to the individual consumers here. First of all, you've got all these people that purchase the product at the price of $8,000. Well, they presumably are still in the market, or people like them are still in the market when the price falls to $6,000, but they're paying $2,000 less for each diamond. So they're getting this rectangular area is the increase in surplus that's going to the customers who would have purchased the product even if the price were at $8,000. But they're each getting $2,000 of extra value because of the lower price that now exists. So that's the first component of the improvement in welfare for consumers. But then there's this little triangle over here that's being created. And it's worth pointing out that here we've got individuals who would not have been willing to pay $8,000 for the diamond before, but they're willing to pay $7,500 or $7,000 or $6,800 or whatever, somewhere in here. Those individuals actually enter the market and buy up the extra 2,000 diamonds that are being supplied because the price has dropped far enough for them to now gain some surplus by virtue of entering the market and purchasing the product. All right, so Not only does the lower prices benefit kind of the current regular customers in the marketplace, and then it's also, consumer surplus is also increasing because of the increase in total consumers, consumption, and the lower prices that they get to pay. All right, so final conclusion down here is that competition is actually causing an increase in diamond consumer welfare. All right, so now we've got a trade-off taking place because of competition. Note, we've got firms who are doing a little bit worse. We've got consumers of the product who are doing a little bit better. What we want to do, what we like to do in economics, is to treat the gains and losses kind of equally and say, well, what's the total market effect as a result of this change? We're measuring the benefits and losses in dollar terms, so we can add them together and we can find out what the net effect is likely to be from this change, right? So let's go ahead and do that. Okay, so what's total market welfare? First of all, defined. It's defined as the summation of the profits that are being earned by the firm or firms, plus the total amount of consumer surplus that is accruing to all of the consumers in the marketplace. All right, so what is the market welfare with the cartel in place? Answer, $25 million is what the cartel was making in profits at first. $12.5 million is this consumer surplus that's being earned by the consumers. Add it up, and we end up with $37.5 million in welfare to the market in the monopoly case. But with competition, which is this second one, profits fall to $21 million, but consumer surplus rises to 24.5, making for a total welfare of $45.5 million. Substantially higher in overall economic benefits are accruing to individuals now in the marketplace because of the extra competition that's taking place. So if we say, well, what is the market effect of competition, or in this case, moving from monopoly to duopoly? The answer is that competition is going to cause an overall increase in market welfare. The benefits that accrue to consumers are going to outweigh the losses that accrue to the producers, and we're going to end up ahead overall in terms of the amount of happiness that's being generated in the economy as a result of market activity in this product. And here, let me pause 1 second and just emphasize that whenever we talk about consumer welfare or producer welfare, we're talking about it vis-a-vis or with respect to this particular market that we're analyzing at the time. So when we say that consumers benefit from the competition in diamonds, you know, if I don't buy diamonds this year, I'm not in the market, I'm not affected, I'm a consumer, but I'm not affected one way or another. It's only consumers of diamonds or potential consumers of diamonds that are being affected by this market adjustment or change. Similarly, it's not all producers in the country that are hurt or benefiting from these changes. It's only the producers within this particular market. So sometimes I'll ask you to specifically tell me who's winning or who's losing from certain changes. And I would really like you, take this mental note now. I really want you at best to say, you know, consumers of diamonds are benefiting from competition. Don't just say consumers benefit, you know, because that, when you throw it out like that, it sounds like, oh, you mean everybody who's a consumer is benefiting from this change, and we don't really mean that. So it's important to try to introduce precision into the way in which we talk about things, because it matters sometimes. Now, there's one more thing I want to highlight here. This was just creating a duopoly, right? So we just increased one firm and we were able to slide down here. But what if we introduced more firms? What if we moved to an oligopoly? Well, the effect is going to be to continue to lower the prices and increase the quantities along this demand curve. So the more firms we add, the further down we're going to slide down this demand curve. Now there's an extreme. We can't go beyond this particular point. This is a marginal cost equal to $3,000, let's say. And that's the marginal cost in this particular example. So we can't get any further than that, because if we did, the firms would not make enough money to stay in business. But by adding more and more firms to the marketplace, we're essentially sliding down the demand curve, reducing the profitability of the individual firms, but at the same time increasing consumer surplus by even more each step of the way. right? And we're going to see that more vividly next class, in fact, when we start to introduce this concept of perfect competition, where we're going to jump directly over oligopoly, and we're going to jump to a situation where there are numerous firms competing with each other to supply a product in a marketplace. And we're going to think about what the outcome in the market is likely to look like in that particular circumstance. And we're going to see this result here. We will slide further and further down the demand curve until the price that gets charged in the market is closer, if not equal to, the cost of producing that individual product. In other words, competition is going to eliminate the profitability of the individual firms.